Good day, everyone. I am Jean Isabel Tan, and I will be discussing how to prepare financial budgets. As discussed by the previous reporters, operating budgets reflect the operating activities of the company. Meanwhile, financial budgets reflect the financing and investing activities of the company. Two kinds of financial budgets we will be tackling are cash budget and capital expenditures budget. What is a cash budget? Cash budget estimates the expected receipts or inflows and payments or outflows of cash for a period of time. It combines much of the data developed in the preceding steps. It is essential for a company to develop a cash budget because cash is vital to the continuity of its operations during the period. For this discussion, the preparation of cash budget has two sections: the estimated cash receipts and the estimated cash payments. The cash receipts section lists all of the expected cash inflows during the budget period. These are estimated cash receipts from cash sales and collections on account. These may also be obtained from plans to equity issue or debt financing, and other sources such as interest revenue. The disbursement section summarizes all cash payments that are planned for the budget period. Estimated cash payments must be budgeted for operating costs and expenses. Other cash disbursements and payments for capital expenditures, dividends, interest payments, or long-term debt payments may also be planned. Let us now see the sample data of Elite Accessories Inc. The budgeted sales of the company are $1,080,000, $1,240,000, and $970,000 for the months of January, February, and March, respectively. Their accounts receivable as of January 1, 2016 is $480,000. The budgeted cash collected for a particular month is 60% of the current month's sales on account and 40% from the prior month's sales on account. For example, 40% of the budgeted sales in January is expected to be collected in February, and 60% of the budgeted sales in February will be collected on the same month. To properly present and estimate the cash receipts from cash sales and collections on account, a schedule of collections from sales is prepared. On the first row, we present the cash collected from prior month's sales of January, February, and March, respectively. On the second row, we could present the cash collected from the current month's sales. We could tailor our presentation of this schedule depending on the collection history of a company. There might be instances wherein the company would be able to collect cash from their sales up to 3 months or maybe more. Let us now see the values indicated in cash collected from the prior month's sales, and the computation shown in Note A. We could immediately assume that the $480,000 accounts receivable as of January 1, 2016 would be collected in January. Based on their budgeted collection scheme, this balance on accounts receivable is 40% of the previous month's sale. As mentioned in the previous slide, the $432,000 is 40% of the budgeted sales of January, which is expected to be collected in February. The $496,000 is 40% of the budgeted sales of February, which is expected to be collected in March. As for the values in cash collected from current month sales, those are all 60% of the budgeted sales, which are expected to be collected on the same month of sale. Computations are shown in Note B. After adding the computed cash collected from prior month and current month sale, the total receipts from sales on account are $1,128,000 for January, $1,176,000 for February, and $1,788,000 for March. Let us proceed to the disbursement of Elite Accessories Inc. The budgeted manufacturing costs of the company are $840,000, $780,000, and $812,000 for the months of January, February, and March, respectively. The manufacturing costs of each month include $24,000 depreciation on machines. Accounts payable as of January 1, 2016 is $190,000. The company plans to pay 75% of its manufacturing costs on the same month they are incurred, and the 25% balance will be paid on the next month. Just like the estimated receipts section, we will also make use of a schedule to properly present and estimate the cash disbursements of the company. Let us now see how the schedule of payments for manufacturing costs is prepared. On the first row, we could present the cash payments of prior months' manufacturing costs for January, February, and March, respectively. On the second row, we could present the cash payments of the current month's manufacturing costs. We could tailor our presentation of this schedule depending on the payment scheme of a company. The computation for the payments of prior months' manufacturing costs is shown in Note A. The beginning balance of accounts payable amounting to $190,000 will be paid in January. For February, it reflects the payment of 25% of the manufacturing costs incurred in January, which is $840,000, less the depreciation on machines amounting to $24,000 per month. The result is $204,000. Depreciation is a non-cash expense, thus it is not relevant in our cash budget preparation. The $189,000, which is 25% of $780,000 of manufacturing costs in February, less $24,000, depreciation will be paid in March. For the current month's manufacturing costs, these are 75% of the manufacturing costs less depreciation of the same month the expenses are incurred. After adding the computed payments of prior month and current month's manufacturing costs less depreciation, the total payments made are $802,000 for January, $771,000 for February, and $780,000 for March. The cash budget report of Elite Accessories Inc. would initially look like this. We input the amounts derived from the schedule of collection from sales in the collections of accounts receivable row, while the amounts derived from the schedule of payment for manufacturing costs are placed in estimated payments for manufacturing costs row. Let us now try to complete the cash budget with the additional data provided. Cash balance on January 1, 2016 is $225,000. The expected transactions the company will have in the first quarter are quarterly tax payment on March 31, 2016, which is $150,000, quarterly interest expense payment on January 10, 2016, which is $22,500, quarterly interest revenue to be received on March 21, 2016, which is $24,500. Sewing equipment we purchased in February 2016 amounting to $274,000. Selling and administrative expenses payment will be $160,000, $165,000, and $145,000 for the months of January, February, and March respectively. If we look at the expected transactions, we can see that only the quarterly interest revenue is the additional cash inflow transaction. All other transactions are cash outflows or disbursements. The minimum cash balance the company wants to maintain is $340,000. The purpose of maintaining a minimum cash balance is for the company to avoid cash shortages caused by cash outflows exceeding cash inflows. It is the lowest amount of cash the company keeps on hand or in bank to meet cash maintenance and planning objectives. It depends on how a company effectively budget its cash needs, how much a company would need for an emergency, and how quickly a company could obtain cash from other sources when needed. Let us place the new data in the cash budget. The quarterly interest revenue expected to be received on March 21, 2016 will be placed under Estimated Cash Receipts March column. As noted earlier, there was only one cash inflow transaction in the additional data given. Thus, the total cash receipts for the months of January, February, and March respectively are $1,128,000, $1,176,000, and $1,102,500. The rest of the given transactions would now be under the estimated cash payment section. After the manufacturing costs row, we could place the selling and administrative expenses for each month with the expected amounts of $160,000 for January, $165,000 for February, and $145,000 for March. Next would be the capital additions, the purchasing of new sewing equipment worth $274,000 in February. Next is the quarterly interest expense payment of $22,500 in January. And lastly, the payment of quarterly income taxes in March, which is $150,000. Adding all the manufacturing costs and the additional transactions per month, we come up with the total cash payments of $984,500 in January, $1,210,000 in February, and $1,075,000 in March. The cash increase or decrease per month is computed by subtracting the total cash receipts of the month and total cash payments of the month. With that, January will have a cash increase of $143,500. February will have a cash decrease of $34,000, and March will have a cash increase of $20,500. The cash balance at the beginning of the month for January is $225,000 as provided in the previous slide. The ending cash balance would be derived by adding the cash increase or decrease to the beginning balance of the month. Thus, for January, the ending cash balance would be $368,500. The ending cash balance of January will now become the beginning balance in February. So in February, the ending cash balance would be $334,500. This will be then the beginning cash balance for the month of March. Adding the cash increase in March and the beginning balance will result to an ending balance of $362,000. After solving the cash balance at the end of each month, we will now input the minimum cash balance per month set by the company. As given earlier, the minimum cash balance for Elite Accessories, Inc. is $340,000 per month. Subtracting the cash balance at the end of each month and the minimum cash balance will show how much is the cash excess or deficiency the company will have per month. So for January, there is a cash excess of $28,500. For February, a cash deficiency of $5,500. And for March, a cash excess of $22,000. In the cash excess or deficiency section, if there is cash deficiency during any budget period, the company will need to borrow additional funds. If there is an excess, funds borrowed from the previous periods can be repaid, or the excess funds can be invested. To simplify, cash excess or deficiency is computed as follows. Estimated cash receipts minus estimated cash payments will equal to the cash increase or decrease. Then add the cash balance at the beginning of the month to the cash increase or decrease to get the cash balance at the end of the month. This will become the beginning balance for the next period. Then cash balance at the end of the month less the minimum cash balance will result to the cash excess or deficiency of the month or period. Another type of financial budget is the capital expenditures budget. This report summarizes the plans for acquiring fixed assets. Fixed assets are prone to wear out and others could become obsolete. This report is often prepared for 5 to 10 years in the future. Some fixed assets may need to be ordered in advance, and construction of new buildings and production facilities may take years. The capital expenditure budget should be integrated with the operating and financing budgets. Purchase of new machineries would also mean an increase in depreciation, thus the factory overhead cost budget would be affected. Planning to buy or construct new fixed assets would need funds, thus it should be input and considered in the preparation of the cash budget. Most companies have more potential projects than can actually be funded. Thus, it is very important that managers must carefully choose those projects that could give the greatest future return. This is the sample capital expenditures budget of Elite Accessories Inc., prepared for 5 years starting in the year 2016 and ending in 2020. Let us have a quick overview on the budgeted balance sheet. A budgeted balance sheet is developed using data from the balance sheet from the beginning of the budget period and data contained in the various schedules. Some of the data on the budgeted balance sheet could be taken from the company's previous end-of-year balance sheet. It is prepared based on the operating and financial budgets of the master budget, and it is dated as of the end of the budget period and is similar to a normal balance sheet except that estimated amounts are used. So that ends our report on budgeting. We hope that you learned and understood more on the definitions and how to prepare the operating and financial budgets of a company. Thank you all for listening and God bless.